Today I'm joined by Rob Mead, co-head of Asia Pacific Portfolio Management and head of PIMCO Australia. Rob, what is the outlook for markets and the economy?
Thanks, John. So this year we're looking for low growth, but fortunately positive growth really throughout the entire world, EM and DM. One of the reasons that we do have this outlook, and we think that the likelihood of recession has been moved down the track, is the central bank support we saw in 2019. Not just from the Fed and the RBA, but from many central banks around the world. We've also had the backdrop of a de-escalation of the US-China trade tension and a UK election, which means that the uncertainty associated with Brexit has been reduced. Finally, we've also seen global trade, the indicators start to pick up, business sentiment improving, but as you know, we've recently had to deal with the coronavirus, which is obviously terrible for the people directly involved and impacted, but we hope that the rapid reaction function from the global authorities means that the medium-term economic impact should be quite limited.
Rob, you touched on a few of the risks already. It's fair to say for the last few years, all market participants have been very mindful of the lateness of the business cycle, the lateness of the macroeconomic cycle, and more in the near term, markets are concerned about the coronavirus, and here in Australia, there's some question marks about the impact of the bushfires. What are some of the risks that you are very focused on in your portfolio management?
Yeah, I think we can sort of sum it up as one big risk, and that's really misinformation. And so when markets tend to be fully valued, and arguably some markets are on the verge of being expensive, any change to the perfect backdrop that requires these valuations to be maintained means that markets are very skittish. So I think misinformation, whether that be around geopolitics, whether it be around health warnings, etc., can really move markets intraday. So this is a sweet spot for an active manager like ourselves. But it does mean that investors need to understand their liquidity positions and understand just how much volatility they're able to withstand over a short-term period. So deciphering from noise and a fundamental shift in the outlook, I think is going to be an absolute key in 2020.
From your perspective, what should be on an investor's to-do list for the next 12 months?
You raise a really good question, and I could sum it up in one simple theme, and that's really to fill the gap. So if you think about, what do I mean fill the gap? If you think about how Australian investors have been invested historically, and this is a generic comment, but I think a very important one, is there's been a barbelled portfolio between term deposits at one end and some sort of equity risk premium at the other. Global equities, property, Aussie equities. And the theme for looking forward is that investors should be filling that gap that exists between cash at one end and risky assets at the other. So the things I'd highlight there is, first of all, sitting on idle cash is a huge wealth drain. So redeploying some of that cash into things like short-term bonds can take you from a negative real return to positive while still providing daily liquidity. Second thing is defensive assets. One of the most defensive assets that still exists are US Treasuries and similar style securities, so high quality securities that have room for the yields to go down. They should be as part of any efficient portfolio. They should be included. Third thing is high quality credit. So high quality credit provides, again, some real return, but also acknowledges that economic backdrop we talked about at the start, that things will be okay. We're not expecting recession. You want to start to earn that carry to the extent you can in a portfolio. We'd be a bit cautious about generic corporate credit. We'd much prefer investors to focus on anything that has some exposure to the US housing market and the global bank capital, excluding Aussie bank hybrids, which we think are already over-allocated and look quite expensive. The fourth thing would be thinking about ESG. Like ESG is a huge theme. You mentioned the bushfires. We've mentioned some other issues that are clearly affecting investment outlooks. And I think the E, the S and the G are all equally important in finding sustainable investments for portfolios, something we spend a lot of time and effort on. And the final thing I'll talk about would be illiquidity premium. As I mentioned, we think investors are way overweight equity risk premium, but they're actually underweight illiquidity premium. Now, there's different ways to take advantage of that illiquidity premium, but one of those is in private credit. And we think that's an under-allocated component for many of our clients' portfolios. So in summary, I'd say be prepared for a lower return environment, be cognizant of some alternate scenarios, so maintain your liquidity that you can deploy if there are bouts of volatility. And most importantly, expect much more from your managers. This is a great time to be an active manager, and you should be expecting a lot more from managers like ourselves in terms of generating the returns that our clients expect.
Well, thanks, Rob, for sharing those insights.